Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Noah Miller. He is the president of Royal Palm Funding, a nationwide commercial real estate lender providing first mortgage bridge loans. Royal Palm Funding provides accredited investors the opportunity to passively invest in mortgages earning between 9 and 12% annually. Noah, welcome to the show.
Keith, thanks so much for having me. I've seen your show many times. I'm a big fan, so happy to be here.
Awesome. That's great. Always good to have somebody on the other end that's a fan and has watched the show. So that's fantastic. And Noah, usually what I'll do is start really with, where you grew up. Tell us a little bit about yourself and what eventually led you to the profession of real estate.
Absolutely. So I grew up in Philadelphia. Born and raised there. I moved to Florida when I was in high school. I went to the University of Central Florida in Orlando. And when I graduated, I moved down to Miami and started my real estate career. What got me into real estate, I think, was I had a couple internships in college that I was interested in that were real estate internships. One was on the brokerage side, one was on the multifamily side. And after a couple of those internships, I knew it was a field that I liked. I didn't know exactly where I wanted to be, what side of the real estate business I wanted to be in, but I knew I liked real estate. So when I graduated college and moved down to Miami, I ended up working for a small brokerage for a while and then quickly got a job at a institutional multifamily owner-operator business. They were based in Miami. When I joined them, they owned about 4,000 units, give or take. And I spent about 7 years with them, worked my way up, started as an analyst, became senior analyst. Then I ended up becoming vice president of acquisitions and finance of that company, helping them buy apartment buildings, but also lend on apartment buildings and provide preferred equity and mezz as well, which is an interesting structure. So again, I was there for about 7 years. And then in 2020, I decided it was time to go off and do my own thing. And that's when I left and started working in the small balance bridge department, which is where I am now. So it's one of those typical stories of getting your foot in the door, working hard, building your way up, and exploring different opportunities in the marketplace.
Yeah, that's pretty interesting. And I'm sure you learned a lot, especially with that large of an operator, just having that experience and kind of working your way up to acquisitions.
Anytime you have the opportunity to learn with a group that is forward-thinking, driven, and professional, it's always worthwhile to take it. I was very fortunate to, in my early 20s, get that kind of opportunity. And I was happy to work hard to grow my professional career and move up the ladder there. So very fortunate to have that opportunity.
Yeah. And what were some of the maybe lessons that you learned kind of while working under them or, as you were kind of moving to today, whether that be on the lending side or just, on the commercial real estate side altogether?
Yeah. I think related to real estate, I think the first thing is real estate's a cyclical business. You have to be patient. I think you might see a lot of people around you getting rich very quickly in cycles, but those individuals can get caught up in the cycles. and it might not turn out so well. So I think the first and foremost is real estate's a cyclical business, and you have to be patient. And there will be opportunities if you're patient. That's one. But the other one is I think applicable in every industry, which is relationships. Real estate's very much a relationship business, but so were a lot of other industries. And there were people who I met. It's funny that I was talking about my internships in college. I still speak to my boss from an internship in college. I still speak to now. And by the way, I have a very close relationship with them, and we actually have worked together on things since then. So I think it's about building relationships with people and keeping those relationships alive throughout the years, because people who you met 5, 10, 15, 20 years ago, one, they'll be a good resource, but they might be able to help you out down the road.
Yeah, for sure. No, I think that's right. And as you mentioned, it's across any industry. It doesn't just have to deal with real estate, but relationships are key, and it's even more so, I think, in the real estate arena. So. Yeah. What about your so we'll get into Royal Palm Funding and some of what they have to offer, but just curious, with your background, kind of what your investments look like.
Our investments are what I consider some of the best risk-adjusted investments out there. We typically invest in first mortgage bridge loans on existing commercial real estate. So we are a lender. Borrowers will come to us. They're either buying or refinancing commercial real estate. It could be a shopping center. It could be an office building. It could be a single family investment home. They'll come to us. We'll usually lend 65% of the purchase or value. We have a first mortgage position, so we're first in line to be paid. And we act basically as a bank, for lack of better words. We're the bank. Our leverage is very low. Our returns are high. It's a good way to be in real estate because when things go well, you are earning nice monthly income. If things don't go well, just like a bank, you end up with a portfolio that you own, and your basis in it is fairly low compared to what you would have to pay if you were buying that in a normal market. So those are our typical investments.
Okay. And maybe for the audience and for myself, when we talk bridge loans, can you maybe explain, Noah, what exactly that term is? What's different about a bridge loan compared to, say, just going out and doing financing for a purchase? Give us some background on that.
Sure. So the term bridge loans, really, you're bridging a gap. People are not coming to us for conventional 30-year mortgages. If you have a stabilized property and you can go to a bank and get a 30-year mortgage, you're probably better off doing that. Right. People come to us because we have to bridge a problem. And that's usually one of three things. The first one is the individuals who are either buying the real estate or refinancing the real estate don't have a lot of time to close. Anyone who's gone to a bank for a mortgage, they know that a bank or conventional lender may take 30, 60, 90 days to approve a property, to fund it. And that's wonderful if you have that much time. But for a variety of reasons, borrowers might not have that much time. For example, maybe they had another lender lined up. That lender decided they didn't want to move forward. They're up against a time frame on a contract and they only have 2 weeks or 3 weeks to close. They might come to us to bridge the gap, right? To close in 3 weeks and then refinance us out with another lender in 6 months. That's one option. The other one is the property's transitional. Typically, a bank or a conventional lender doesn't want to lend on a property that has some vacancy. So maybe if you're buying a shopping center that's 50% occupied, a bank doesn't want to touch it. So they can come to us. We'll give them a loan for 2 years. It'll allow them time to renovate the property, lease it back up, and then they can take us out in 2 years with conventional financing. The third one is there's some sort of, I'll say, red flag on a borrower's background or history where a bank's a little bit nervous to lend to them. Maybe, for example, they went through a foreclosure before. Maybe they went through a bankruptcy. Maybe they don't have a ton of experience. So not necessarily things that make the person a bad borrower, but in the eyes of the bank, maybe not something that they would consider bankable. So it's usually one of those three reasons why someone would come to us for a bridge loan.
Okay. Interesting. And then what about from a qualification standpoint? Obviously, you're going to look at the value of the property. You said, vacancy isn't much of a problem, but do you have parameters with respect to vacancy and maybe with respect to, it sounds like 65% LTV. Give me some some of the other things when you're trying to qualify a borrower or a property, kind of what you look at.
Sure. So we definitely have our parameters. At the end of the day, even though we're lending on these properties, we are investing in the properties, right? We're putting our money out and we're collateralized by that property. So we have to have a lot of faith in that property and that our basis, our 65% leverage makes sense on that property. So we definitely have parameters. The first and foremost is what is the value? The leverage point is going to be the best case or the best way we look at property. We really don't want to be more aggressive than 65%. If we're at 65%, it means that the borrower has enough skin in the game, that they're not just going to let the property go. It means they're invested in the property. It also means that our basis is low in case something does happen and there's a foreclosure or default or any scenario. In terms of geographical locations, that's a big thing we look at. We really only want to invest and lend in markets that are growing. There's a lot of markets in the US that are shrinking. There's a lot in the Midwest. There's a lot in the Northeast. Obviously, if you go to more of the Sun Belt states, more of those markets are growing, but we only want to be in cities that have population and economic growth. We want to make sure that any lending we do, any investing we do, those cities and properties will be better off 20 years from now rather than a city that's losing population at 10% every 5 years or whatever it may be. In terms of property as well, we do need to, if the property is not operating at full capacity now, we need to believe that it's going to be operating at full capacity. So even though something's 50% leased or 50% occupied right now, maybe it's because a large tenant just left. Maybe their lease ended. We just did a deal, actually, great example in we're based in South Florida. We did a deal in Fort Lauderdale, fantastic 6,000 square foot retail building on a prime location. The property had been occupied for the last 15 years with a tenant, and that tenant just left a couple months ago. So it was vacant. No bank would touch it because it was 100% vacant. But that property is primed to be leased up sooner rather than later because of its location. So the borrower came to us and said, I already have a tenant who's looking at this space. I'll have it filled in 6 months. I just need to do a build out and sign the lease. So we did a bridge loan on that. So we have to believe that there's future value in the property if it's in a transitional period. We definitely have our parameters that we work within, but we have to be very understanding. That's why they're coming to us. If it was a simple, clean, easy deal, they would go to a bank. So we have to be understanding that some deals might be a little more situational than a conventional, clean and steady deal that a bank would lend on.
What about, you mentioned population in an area that's growing. What do you like to see as far as a growth rate and then maybe as a minimum population of an area that you'd be willing to lend in?
Yeah, it's a good question. I don't like to lend in markets less than 50,000 population. Selectively, I'll do it. Selectively, I'll go down to 25, 30,000 as long as they've seen a lot of growth and I believe there's going to be more growth. But in terms of raw numbers, as long as there's an upward trend, I'm usually okay with it compared to a downward trend. If there's a downward trend, I'm usually staying away from those markets. But, Florida, for example, has seen insane population growth the last couple of years, way faster than, let's say, South Carolina. But South Carolina still has that strong growth. So I'm happy to go to a market like that. So it doesn't necessarily have to be 10% every 5 years or an annual number. It just has to be an upward trajectory.
Right. Okay. That sounds good. And then what, you mentioned this vacant retail space that you did the lending on recently in Fort Lauderdale. Yeah. What, on something like that, you'd said a 2-year term. Is that really about the limit that you do? You look for something that can be turned around within a 2-year time frame. And then the goal for the principal is to refinance at that point?
Yeah, exactly. The average duration of a loan of ours is around 24 months. We have some that are longer. We have some that are 36 months, but the average loan is 24 months. The goal really of our borrowers is to get in there, fix the problem, create value in the property, take us out with a more a lower priced bank loan that's probably a conventional loan. And our investors, by the way, they're not looking to place their capital for 10 years. They're looking for short-term hold periods with liquidity. So that's why they come to us, because a loan could be 6 months, it could be 12 months, it could be 24 months. So our investors' capital isn't tied up that long. It's usually short-term in nature. And then there's a liquidity event. they get the capital back and they can choose whether they want to reinvest in another loan or cash out and put it into something else.
Okay. And you mentioned a little bit about the asset classes, but maybe kind of go through that again. What type of asset classes do you like and are willing to lend on?
We're pretty much open to what I consider conventional commercial, which would include retail, office, multifamily, mobile home parks, triple net properties, some light industrial, but it also includes residential investment properties. And that would really be either a single family investment home someone's buying, whether it's a fix and flip or a stabilized property, as well as investment condos. So that's what we stick to. Nothing with real levels of expertise. For example, we really don't do hospitality, which is a
Right.
totally another animal. We really don't do ground up, which is construction is really not our expertise. So we stay away from that. We really focus on stuff that we know how to manage and operate. In case at the end of the day, it becomes a property that we own.
Okay. And then the 65%, is that the same even on the single family that you're trying to keep it at right around that much
Typically, yeah.
loan to value?
Typically, yes. There's some deals where we say this is a fantastic location. We love this asset. We're willing to go up to 70%, but we always like to stay around 65%. That's a pretty solid basis to be at. Again, it leaves us enough room. And it leaves enough skin in the game for the sponsor, for the borrower.
Right. Yeah, I think from a lending standpoint, it makes a whole lot of sense. Maybe let's talk about some of the advantages on a loan like this for investors, for passive investors that are saying, "Hey, I'd like to get into the real estate game, passively." And what are some advantages of investing with debt instead of into like say multifamily syndication?
Sure. The large advantage is where you are in the capital stack and your risk level. Being the debt provider, the lender, the first mortgage, you're in the least risky slug of capital because you're the first ones to get paid back. When you're equity, you have a lot more upside, but you're also in the riskiest stack. And that's a great investment option for those individuals looking for higher returns with higher risk level. A lot of our investors, what they're looking for is almost an alternative to fixed income. They're saying I can put my money in a bond or treasuries or CD and earn a monthly interest return, or I can take a little more risk because of course there's risks involved with being a lender, but I can get much higher returns and they're still typically paid out monthly. So we have a lot of individuals who are retirees who invest with us. We have a lot of individuals who already have a nice allocation towards equity and real estate or towards the stock market and are looking for something a little safer. Again, less risk, less return. So people come to us for, again, passive income, typically monthly distributions, and still have a concentration in real estate because they still believe in the asset class and they want to be invested in real estate deals. The other thing to mention is a lot of people do it in tax deferred and tax advantageous ways. For example, they've invested with us in their self-directed IRAs. A lot of people have done that because then they don't pay taxes on it and they're getting fixed income and monthly returns, but basically able to not pay taxes on it. So there's a variety of reasons why people invest in debt and first mortgages.
Okay. Yeah, it makes sense. And you're right. As you mentioned, you can maybe walk us through this, but look, if a deal goes south, it's not going back to another lender. It's going back to you. You are the lender on it. And then what are some of the exit strategies maybe for a deal that does go south? Obviously with only 65% of a loan on it, that gives you a lot of outs, a lot of ability to be able to turn around and, sell it to somebody else. But what are some of the outs and how often are you seeing anything? Obviously this environment that we're in right now is a little bit squirrely compared to, a normal market. But
Yeah.
are you seeing any more default in this particular market?
So I'll start with the last question. Are we seeing more defaults? We're not seeing too many more defaults. I will say there are some individuals who maybe are having a little more trouble, but we're working with those individuals. Our goal as a lender is to always have our borrowers succeed. We want them to do well. We want it to work out. At the end of the day, our goal is to lend money and get it back. That's our goal. If we need to, we'll put borrowers on payment plans or defer payments. We've done that and we're happy to do that. We want to work with our borrowers. On the flip side, as you said, and as any lender knows, if things do not work out and the borrowers do not make payments, the lenders take back the real estate and then become the owners of the real estate. And there's a lot of upside in that. There is, because you now own a piece of real estate and your basis is 65% of someone else's 100% purchase price. In terms of that, the question is what the exit is. It could be two things. One, it could be a sale if we believe that it's a property that we want to dispose of. We could sell it. The other thing is we could hold on to it. And now it's a piece of real estate that we own and it's a cash flowing piece of real estate. We do both. It's very much dependent on the property location, the amount of rent we can get for the property, et cetera. I will say most of our investors prefer if we hold on to real estate, lease it out, and then they now have a cash flowing piece of real estate that they get a monthly distribution on. And again, everyone's basis is way less than it would be if we purchased it today. So that is a part of the business that can become very advantageous. It doesn't happen too frequently, which is a good thing. Most of our borrowers, they take out a loan, they make the monthly payments, they pay us off in 6 months or 12 months or 24 months. Everyone's happy. But again, any lender who's in the business and anyone who invests in loans has to be prepared for borrowers to default and potentially become owners of that real estate.
Yeah, makes sense. And have there been changes over the last? Obviously interest rates, I'm sure, are higher, but have there been any specific changes? Have you guys always done 65% as far as the loan to value, or has that been an adjustment since the market shifted a little bit?
Yes and no. Our core philosophy has always been to be around 65%. I will say that when a market is a little more liquid, there's more buyers, more sellers, more lenders. There have been times where we've gone slightly higher than that. And again, touched on to 70, again, on properties we really like. But at the end of the day, our core business is safe, conservative, limit your downside. And 65% is that nice number. In fact, there's a lot of properties that we lend on where we're way below 65%. The Fort Lauderdale deal I just mentioned, we were actually around 30% of the value. We closed another deal, an office building in Orlando recently. That was about 50%. So a fair amount of our deals are actually between 40 and 50%. 65 is really the max that we'll do. But we have a lot of people coming to us. We just did a deal recently. The individual owned a Wendy's in Tennessee. A Wendy's with a long-term lease. There was about 30 years left on the lease. It was worth about $2.5 million. And he needed $1 million. So less than 50%, considerably less than 50%. And he needed it. It was owned free and clear. He didn't have a mortgage on it. He needed the money for another business opportunity, and he needed it in about 2 weeks. So we came in and we did a loan in about 2 weeks. And now we have a Wendy's that we have a loan on at less than 50%. So we'll see a lot of deals that are actually under 65%.
Wow.
Yeah.
That's neat. That's very interesting. And that's a great point. I could see, somebody sitting there with, this $2 million asset that they have all this equity just sitting there. A new opportunity comes. And that is a prime example of why you'd want to move quick and be able to move quickly on this. That's pretty fast. How are you able to lend that quickly? I mean, I guess, what are some of the things that you're looking at and from you're surely not getting a full appraisal value back that quick, right? So what?
Yeah.
How's that working?
Keith, that's right. That's a good point, which is, for example, appraisals. We don't require appraisals on our real estate. Most banks and large lenders do require appraisals. And appraisals are a great document to have. To be candid, though, an appraisal doesn't, just because a property is appraised at a certain number, doesn't really mean much. Before I ran Royal Palm, I was involved like a multifamily company. We were buying real estate all the time, and I never saw an appraisal come back less than what we were buying it at.
Right.
Appraisals come back at what someone's buying it for, usually. So we don't put a lot of weight on the value of appraisals. The truth is, we do internal valuations on every property we lend on. We do rent comps, we do sales comps, we reach out to listing brokers for sales and rents. We do a market analysis. So we can pretty much come up with what we believe the true value is without an appraisal. And again, that'll save borrowers 4 weeks of their life and thousands of dollars on costs. So there are things like that we don't necessarily need to get comfortable with the collateral on the property. The other thing is, we're lending our capital that sits on our balance sheet. There's a lot of people who go off and they'll raise the money from Wall Street or get a line of credit. We're sitting on the money already, so we're able to deploy it very quickly, which is competitive advantage in this market.
Yeah. What about for the owners of the property? They come to you with a game plan, with a business plan. I'm sure they have to share their business plan with you as to what, how they're going to turn this property around. You guys evaluate that, say, yeah, this makes sense. It looks like something that, that they should be able to execute on. When it comes time to refinance, do you have other lenders that you work with on the permanent side, or that you can refer them to on the permanent side? I say permanent, but on a
we have some. It's not necessarily our business model. There have been times where borrowers will come to us and say, "Hey, we did this loan with you a year ago. We renovated the property. The value is now increased by 20%. Can you introduce me to someone?" And we'll do that. But more than not, we usually stay out of that. Usually our borrowers will have their relationships with conventional lenders for the permanent financing.
Okay. Yeah, makes sense. Obviously, and they'd be somewhat competitors that, I guess, not really a true competitor, because you're taking it before all the improvements and the stabilization is happening.
We've had some kind of full circle deals where we've had people come. I've had lenders come to me and say, "Noah, I love this property. I want to lend on this property, but they need to execute their business plan first. Will you give them a bridge loan for 6 months or 12 months? And then once they're done, I'll take them out with permanent financing." We're actually doing that on a deal in Chicago. We lent them money about 18 months ago. It was an old supermarket, and he converted it to a space for himself, an owner-operator space. And the person that brought me the deal is now doing an SBA loan to take me out. So we have some deals like that come full circle, which is always nice to see.
Yeah, that's neat. What are some of the other things that people should know about, this type of lending that maybe we haven't covered yet?
Yeah, I think that people should know, again, the upsides and the downsides, obviously. And the upsides is you're investing in good quality commercial real estate. You have potential for almost equity-like returns with debt level risk, but you also should be aware of the risks investing in debt. Not every deal goes as planned. Some deals you're expecting to get a monthly payment and the borrowers don't pay and it goes into default, and that takes 6 months to work out. And you might not receive an interest check for 6 months. Eventually you'll receive one, right? When either there's a payoff by a new bank, or they sell the property, or eventually it goes through a foreclosure. But like anything in real estate, there are always risks and nothing's guaranteed, and you have to understand the ups and downs of it. But in today's market, I don't know if there's a better risk-adjusted return. I think investing in mortgages and debt is a pretty safe thing to do in the real estate market, and your returns are relatively high compared to the risk level. So I think it's a good place. It's why I'm in it, and I believe in it.
Yeah, for sure. And then what about on these, from an investor standpoint, you can invest within an IRA into this type of investment, and there's no depreciation, but you have the ability to be able to invest tax-free. Is that correct?
If you invest through a self-directed IRA, then yes, you can invest tax-free. Individuals will invest through a variety of platforms. They could do it through their individual name. We have a lot of investors who do that. We have a lot of investors who invest through an LLC or a trust. And then again, we have a fair amount who invest through self-directed IRAs as well. That's a big one. That's a real big one. We have a couple platforms that we've worked with and partnered with who have made it really easy. And then a lot of investors come to us and they say, "I already have a custodian, I already have a Roth IRA set up, and I want to invest in real estate. So there's a lot of ways to do it, which makes it easier for investors. Actually, we have investors who do it. I have an investor who invests all three of those ways. Actually, he's invested through his IRA, he's invested through an LLC, and he's invested in his own name for different purposes. So we have a lot of unique investors. We have investors that really run the gamut, but it's interesting. We have a lot of historical real estate investors. We have people who have owned real estate, mobile home parks, multifamily their whole life, and they want to diversify out of some of that equity risk and put it into debt risk. So we have a lot of those. Then we have a lot of, I'll call them your typical high net worth investors who are doctors, lawyers, retirees who are just saying, I want to put 50,000 or 100,000 into a product that pays me a 9% or 10% return. I want to set it and forget it, and we have those too. So it really runs the gamut.
Okay. And the structure of it, the way that the fund is set up, it is a fund, right? So you mentioned
we're not a fund. The way we structure our deals is really on a deal by deal basis. So
okay, perfect.
So for example, if you come to us and you invest with us, you know exactly what you're investing in. You decide what you want to invest in. We might have two deals at the moment. One might be a shopping center in Fort Lauderdale, which you absolutely love, and one might be a single family home in Texas. You might say, I don't want to do single family homes. I don't want to be in Texas, but I love the Fort Lauderdale deal. And you go right to the Fort Lauderdale deal. So you're selecting exactly what you want to be in. You're not in a fund where you're blindly investing. Yeah. And a lot of them like that. They like the control of knowing where they're investing, what type of product they're investing in, what the duration of that loan is.
Yeah, no, that's great. I think that's really good. And what kind of information are you sharing? Just kind of the basic overview. This is what it is, and here's what kind of information are you giving the investors so that they can make the decision on which ones they want to?
Yeah, we're giving them everything. We're giving them an entire due diligence folder.
Oh wow!
Usually, what I'll do is I'll provide them with base level information on the property, the story, and what I call a credit memo, which has it summarized. And if they're interested, then I will provide them the entire due diligence document, which has our entire underwriting on it, all the information on the borrower, all the information on the property, financials, rent rolls, income statements, bank statements, credit report. Obviously, we do an inspection of the property. It'll have everything in there that they need to do a full evaluation on the property themselves. We provide them every single document that we receive.
Okay. And from a lender's perspective, on the due diligence, what are some of the, maybe some of the surprises that, that's one of the nice things about having a lender on a deal is that you get another set of eyes on, all of the ins and outs of it. But what are some of the surprises that maybe come up or that you get discovered in that due diligence?
Yeah, fortunately, most of them are straightforward. Most of them, they tell us the property's earning $100,000 of income. We get the financials, the bank statements. They are. But like any business, there are those random ones that come up and they surprise you. We've had properties where borrowers tell us that, it's 100% occupied and we go in and 50% of the units are completely vacant, right? We've had those before. And obviously we don't move forward with those deals. Or we say this isn't as it was presented to us and we'll still do the deal, but we need to dramatically change the terms. Maybe before we were giving them, $500,000 and now we're only willing to give them $300,000 or whatever it may be. You see stuff like that. Or sometimes, people will give us, sometimes people tell us the property's in immaculate condition and then we'll go and do our property inspection and it is not in immaculate condition. It needs a lot of work.
Right.
So again, a situation like that, we may decide we no longer like the real estate, or we may say, you know what, we still like the real estate. It needs a new roof, but maybe what we'll do is we'll give you the loan, but we'll hold back $50,000 or $100,000 to repair the roof. That way we know that we're investing in a property that has a new roof or whatever the situation may be. So you always have little stuff like that comes up on select properties. And it's up to, our team to decide whether or not we're still comfortable. And if so, where we are comfortable. At the end of the day, we have to be comfortable. If we're not comfortable, I will happily pass on a deal. I will happily say, we looked, that's not for us. The last thing we want to do is invest in real estate that we don't believe in. That's not our business. The truth is we're under no pressure to do deals. We only want to invest in deals that we really like and deals that we believe in. We probably pass on the deals we see we probably pass on 95% of them because they just don't fit our bucket. Probably only 5% we're actually interested in. And then even out of those, only a portion of those we actually end up lending on. As
Right.
you probably look at a ton of deals to find the one deal that you like. I'm sure you look at 100 deals until you find one or two that you like. That's anyone in the real estate business.
Yeah, that's truly the nature of the game. And then, just being able to say no. I mean, not accepting everything. Every kind of war story I've heard where somebody bought the wrong property, it all has to do with maybe getting out of their wheelhouse and doing something a little different than they would have normally told themselves. We're going to stick with these guidelines. So I think that's a smart way to approach it, and just making sure that you're sticking with what you know and what you're comfortable with.
Yeah, 100%. Too many people, especially in growth times of real estate, like we've seen over the last 10 years. Obviously, forget about the last 12 months, but before that, a lot of people got involved in a lot of real estate that they either weren't prepared to, they took unnecessary risks with leverage, and some of them have made a lot of money, but some of them have made a lot of mistakes too. Our business is kind of the opposite. Our business is, regardless of where the economy is, regardless of where we are in the cycles, we are lenders. We are low leverage lenders. We're investing in good quality real estate in good markets. That's kind of the opposite of these. We're not looking to hit home runs, right? There's a lot of people out
Right.
there who are very good at hitting home runs. It's not our basis. Our goal is to hit singles, doubles, maybe once in a while you hit a triple, but we're a very consistent, slow growth, conservative company. And that's the space we like to stay in. And by the way, that's what our investors are asking for. Our investors are asking for the singles and doubles. There's a lot of companies like that who the investors want the home runs, and God bless them. I've seen a lot of them do well. It's not our model. Our model is slow, consistent, conservative, safe. That's our model.
Yeah, I think that's a good model for sure. What about, so maybe going back a little bit to the structure of how these work? You mentioned being able to kind of have some insight and select the property that you're interested in. My assumption, though, and you can correct me if I'm wrong, but is that maybe let's say I've got $50,000 to invest, and I'm interested in some larger commercial stuff, but I've only got 50,000. Obviously, the loan amount's probably going to be much higher than that. So are you kind of pairing up different investors to fund a specific deal, or what does that look like on the back end?
Yeah, that's a great question. And that really fits the mold for a lot of our investors, Keith, which is we have investors who say, I want to put in 50,000 or 100,000, but most loans, especially on large real estate, are not 50,000 or 100,000. They could be $500,000, $1 million, $5 million. So yes, exactly. What we do is we basically allow investors to invest in a deal. So they are invested in that deal. They get their pro rata share of it, but with smaller check sizes. So 50,000, 100,000. The minimum check size we usually accept is about 20,000.
Okay.
But on the other hand, we do have some investors who come in and say, I'll happily write a check for $2 million or $5 million. A lot of them have a number in their mind. They say, I want to invest $500,000 into this space. And they like to self-diversify. So they'll say, all right, I'm going to do $500,000. So I want to invest in 10 deals and do 50,000 each. And that's my way of self-diversifying the amount of money I'm willing to put into these deals, while also picking the specific deals I like based on geography, property type, et cetera. So yeah, but that's exactly how we do it.
Okay. Yeah, that's pretty neat. And I like the idea of doing that if you have a big amount that you want to invest, but just maybe splitting it up amongst other deals, all still debt fund deals or debt lending, but it kind of diversifies it amongst the different operators and all of that. So
yeah, absolutely.
All right. So tell me a little bit more, Noah, about Royal Palm Funding. Anything else that the listeners maybe should know about your company?
Yeah. Again, I think that for individuals looking for passive income in the real estate field and are looking for a a less risky option than equity, a debt provider is a good choice. I will tell you that I'm always available to jump on a call. I know every single one of our investors personally. I never allow anyone to invest without me speaking to them personally, meeting them in person, or at least having a phone call or two. I want to make sure that our investors are aligned. We're partners at the end of the day. That's what we are. We're partners in this business. We're doing a lot of work. We're putting a lot of capital out there, and obviously our investors are putting capital out there. And I want to make sure we're in line. I want to make sure we're a good fit for them, and I want to make sure they're a good fit for us. So I know every single investor personally. If you are interested in investing or learning about our business, reach out to me. You can email me at noah@royalpalmfunding.com. You can go on our website, royalpalmfunding.com. Happy to send you some information on some deals we've closed. Happy to get on a call with you and answer any questions. But again, this is it's a good business to be in. It's a good time to be in. A lot of banks and conventional debt funds have actually limited their lending recently because of what's going on in the economy. And because of that, we're able to provide liquidity in the market, and we're able to provide loans on good quality real estate to good quality borrowers who may have gone to a bank 6 or 12 months ago, but are not going to a bank right now. So it's a good space to be in, and I welcome any questions or conversation with any of your listeners who want to learn more about it.
Yeah, sounds good. I think it's an important product, especially in these times. I would think that in every time it would be good, just because there's not always going to be a stabilized property. There's always going to be some that you got to take it from point A to point B, and this is the perfect product to be able to do that. From an investor standpoint, there's a lot of opportunity there. It's really healthy returns. So I think there's just I can't say enough good things about it. It's a great opportunity. Tell me one more. So you've mentioned Florida, you've mentioned I think Chicago. Geographically throughout the U.S., are you pretty well everywhere, or is there a specific? I know you mentioned trying to stay in growing areas, but tell us a little bit about the states you lend in.
We are diversified in terms of the states we lend in. Most of our portfolio tends to be East Coast, Southeast, Midwest, and Texas. Those are the major markets. Okay. We like those markets. Again, those are high growth markets. Anywhere people are moving, economic growth, economic drivers, we like that. We really don't lend on the West Coast too much. It's a whole nother animal out there. So again, we stick to markets we know, that we've invested in before, that we have relationships with. And again, most importantly, that have good economic drivers and population growth drivers.
Okay. And then your investors, my assumption would be that you have a lot of repeat customers that, they've come in, they've tried a deal. These durations are, fairly, fairly short time frames, right? I mean, a 2-year, and I would assume if it's a 2-year, it very well could get refinanced out well before that 2 years. If the business plan goes quicker, that 2-year just kind of gives them a buffer. But tell me a little bit about what you're seeing from your investor standpoint.
Most investors tend to stay with us. Usually, a common theme I find is, let's try out one, and then they like what they see and they invest more. They tell their friends, and then you're right. A lot of our loans may pay off in 12 months, and they say, "I want to keep my money in. What else do you have for me? What other deals do you have for me?" And we can put them in another deal. That's fairly common. That's typically how it goes. We're very fortunate, again, to have an investor base who understands our business and has the same mentality of us, which is long-term thinking, conservative underwriting, conservative growth. And they like the fixed income product. A lot of times they look at it and say, I could go into a treasury bond, which has no risk, but I'm getting a much lower yield. Or I can put it in the stock market, and maybe I can get a similar return. Maybe I can get a higher return, maybe a lower return, but I don't really want to. I'd rather have the fixed income than the volatility right now. So most of our investors tend to be repeat investors, which I'm very proud of. I'm proud of the fact that we built that relationship with those investors. That's a great responsibility. Having investors put money with you, and we take that very seriously.
Yeah, for sure. Well, maybe Noah. First, I've enjoyed this quite a bit. A lot of good information, just an intriguing investment opportunity. Not just I'm looking at it both from an investor standpoint, but also as a principal and the potential to be able to use it for any deals that we have here in the future. Tell everybody, I guess, one more time where they can find out more about you, and then I've got a couple questions for you that we ask every guest.
Sure. So you can call me directly at 561-763-4411. You can email me at Noah, Noah, at royalpalmfunding.com, or you can visit our website, www.royalpalmfunding.com. Reach out. Happy to chat and tell you about our business, learn a little about you, and see if we can do something together.
Sounds good. All right. So one question I ask everybody is just if you were to give some advice to somebody who's maybe just starting out in their investment journey, what advice would that be?
Yes, I love that. It's a great question. First and foremost, speak to as many groups as you can. Every group does it a little bit differently. And, it's important to really align yourself with a group that your values are the same. As I mentioned, there are some groups who are willing to take on more risk, some groups that are willing to take on less risk. Usually by having a conversation with someone at that company, you can find out pretty quickly if your values align. The last thing you want to do as an investor is be with a company where your values don't align. It is a recipe for disaster. Make sure that, again, that you speak to them and make sure your values are aligned. Also ask them for history on how their properties have performed, not the good ones, but the bad ones. I think that's really something you should look at. People like to praise themselves for all the good real estate they've acquired or bought or lent on. In any real estate business, people have had properties that didn't turn out as anticipated. And the question is what happened in those scenarios, because those are really the differentiators. So ask them. And if someone's willing to tell you what it was, listen. If they're saying that their track record is perfect, maybe it's true, maybe it's not, I'm not sure. But if they don't want to tell you about their failures, maybe be a little bit skeptical, because they've probably had some failures or at least deals that didn't go as planned. So don't be afraid to ask those questions. And of course, learn as much as you can. Listen to podcasts. Keith puts on a great podcast, which I personally listen to, and I learned from hearing about his experiences and all the other people who come on here. So learn as much as you can and get started. Get started small. You don't have to put in your whole life savings. Get started with what you're comfortable with, and of course, diversify your holdings.
Yeah, great advice for sure. And then how about a book recommendation? Anything that you've read recently that's been impactful? Doesn't necessarily have to be real estate related, though it can be.
I'm a big reader, and I have a lot of good book recommendations. If you are a big reader, reach out to me, send me an email, and I'll give you my full list of book recommendations. I think that there are a couple books that I love. One, The Millionaire Next Door. It just, as a general book recommendation, I think is one of the best books in the world, The Millionaire Next Door. From a real estate book, I think Steve Schwartzman, who started Blackstone, wrote a fantastic book called What It Takes and published it, a couple of years ago. I thought that was one of the best real estate books I've read in a while. I also just read Sam Zell's book. He started Equity Residential, which is one of the largest multifamily operators in the country. He also has Equity Office Group and a bunch of others. His story is also incredible. Read as much as you can. I was reading a book the other day, actually, that said, if you want to learn from great people, read their books. It's a way to have a conversation with them. I'll never meet those people in my life, but I read a book in 5 hours and I learned about their philosophy and their life and how they did it. So I recommend reading any book you can get your hands on, especially if it's in the field of real estate or finance or investing.
Absolutely. No, I think that's great. I have not read the Blackstone one. I did just recently re-listen to the Sam Zell. I might be too subtle. I loved it. It was good. Yeah. So
read the Steve Schwartzman book is excellent. Okay. It really is a great book. I think it's very motivating, and I think he does a good job of talking about. Actually of talking about a lot of his failures too, which I think are really important to learn from. Anyone who's willing to talk about the times they failed or things that didn't go as expected, I think those are definitely people you should listen to, because those are honest people.
For sure. Yeah. And Sam Zell does that in his book as well. And I think it's just, it's great to hear the stories, because you see these icons and oftentimes we think, gosh, they've done just everything right, but they've also made some big mistakes as well. So it's just neat to see.
Yeah,
So.
absolutely.
All right, Noah. Well, hey, I've enjoyed our time together, and I really appreciate you being on the Wealth Flow today.
Keith, thanks so much. I had a great time. I'll continue to watch your show and keep up the great work. Like I said, you're educating a lot of great people, and I know I'll continue to watch.
Awesome. I appreciate that, Noah. Thank you.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.